Welcome Investorholics and friends to another ETF Spotlight review. Hey, I know that there are some investors out there that would like to know more about exotic types of ETFs in the Australian market. But beware, like exotic women, ETFs like bear definitely should be treated with caution and with a certain degree of skepticism, in my opinion. So today we'll look at bear, BetaShares Australia Equities Bear Hedge Fund. This one's brought to you obviously by BetaShares. Well, hello there Investorholics, this is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons and crack your financial sky. Okay, so let's dive in and look at some fundamentals or some background on bear. So the fund objective, bear seeks to generate returns that are negatively correlated to the returns of the Australian stock market. The fund expects to generate a positive return when the ASX Accumulation 200 index falls and a negative return when the index rises. The fund is actively managed and does not track a published benchmark. Looks at the fund strategy. A 1% fall in the Australian stock market on a given day can generally be expected to deliver 0.9% to 0.111% of increase to the value of the fund, or if it goes down, it's the other way. Why on earth would I bother with this? So Hedge can protect your portfolio from market declines without having to sell your shares and crystallize capital gains. Bear gives you the opportunity to profit from the fall in the Australian share market. Investing in bear avoids the cost of complicated futures contracts, CFDs or short selling. Investors are not exposed to margin calls. So the net asset value at closing was $12.40. It's trading below that at $12.16. Management fee is 1.38%. As I mentioned on the previous screen there, this is an actively managed fund, so that's why the management cost is so high. It paid a dividend in one time, 4 years ago, but it doesn't pay a dividend anymore. So the fund invests all their assets in cash and cash equivalents and sells equity index futures contracts, being the ASX SPY 200 futures. Selling futures can be expected to generate a positive return for the fund when the S&P ASX 200 index declines, and the reverse when the S&P ASX index increases, as I kind of touched on before. So it's important for investors in bear to understand its features, including how it's priced, and that it targets return over a 1 day period only. So, you know, to me, this thing really can only be used almost with a daily focus. So a very, very short-term focus. Can't see it really being used as a long-term buy and hold type thing. Personally, I'm not experienced with using these type of instruments, therefore I'm very, very wary of them. Having said that, with a forecast of economic turbulence in the next 12 to 24 months, an ETF like this may come in handy if you're trading with a short-term time frame. As I kind of said, this thing really prices itself on a day-to-day basis, so you might need to actually trade it or operate it on a day-to-day basis. But I think there's this is a niche strategy, unsuitable for the average investor, and I wouldn't recommend it. So this one, I'm not, like I say, I'm not a huge fan of this type of investment. If you want to look at some other alternatives, you got BBOZ and BBUS. So they're both from BetaShares, and they're both high. Those ones are highly hedged. Those ones. So as you can see from the graph on the left-hand side, you can see the non-correlation. So as the ASX goes up, BetaShares performance goes down. You can see the spike in performance right at the end here on the right hand side, where was it the 23rd, 24th of February this year, the market dropped off a cliff, so bear shot up quite dramatically, and as the index is coming back, bear's dropping off again. So it's, to me, it's a very short term type of thing, not really something that the average investor should be looking at. So you can check out the returns here, so you can see the spike I was just talking about. So the last 3 month return, you're looking at 15.66%. But since inception on the 6th of July 2012, you're looking at a loss of 7.37%. I think there's better ways to make money during this time than shifting asset classes and using complex ETFs like this one. It's a simple way to buy good quality ASX companies at rock bottom prices, and just hold them through the market as long as the economics of the company doesn't change. Using an instrument like this, I think, is fraught with danger. You may be able to make some money out of it one day, but the next day you might lose a lot of money on it. So it's definitely one I'd stay away from. Not a huge fan. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks, guys. See you later.